and welcome to the Q3 earnings call of Federal Bank. The management team here is represented by Mr. Shyam Srinivasan, MD and CEO, Mr. Ashutosh Kajuria, Executive Director and CFO, Mr. Ganesh Shankaran, Executive Director, Ms. Shalini Warrior, Chief Operating Officer, Mr. Sumit Kakkar, Chief Credit Officer, Mr. Krishna Kumar K, Head of Finance and Accounts, and other executives. Over to Mr. Shyam Srinivasan.
Hi, good afternoon, and thank you for dialing in. It's the first call of the year, so happy 2018 to everybody. Quick update, results were approved about an hour ago or so, and we've uploaded the results on the website, the investor deck also. So many of you may have had a chance to look at it. Let me just give only the sort of principal highlights, and then we'll, as usual, take Q&A from everybody. The important part of Q3 is the momentum is strong on the operating side, continues to be robust both on the credit growth, importantly diversified across all our product segments. Interest income was the highest ever recorded in the history of the bank. 950 crores was net interest income. Some of the other milestones, we crossed 100,000 crores in deposits. Our overall credit market share continues to grow quite well. We think we are north of 1.05, 1.07 in sort of market share. Products like home loan, personal loan, auto loan, which have traditionally been our lower single-digit growth, are now the handsome growth of double digit, high double digit, and in particular products like PL and auto loan, albeit on a very small base, are growing almost 3-digit. Our relationship management structure, which we've been sort of strengthening across the many quarters, is now 330 people plus strong. And the visible results are, as we can see, growth across the different verticals, whether it's corporate, SME, business banking, or retail, led by both RMs and the branches. The distribution of business between branches and RMs is now visible. RMs were a much smaller share. Now it's almost 70-30. So both on a growing denominator, both are growing, and which has been the focus of the bank. As you know, we sort of went into a branch-like distribution-heavy model, and that meant virtually freezing on branch expansion for almost 3 years, but expanding our distribution, be it our RM, Salesforce, Fedfina, and any other opportunities using BZs and digital. All of that is trending well. We've put out some numbers in terms of the digital trend lines also. New account opening both for credit and deposits is gathering momentum. So all in all, the operating performance of the franchise is strengthening. In fact, operating profit for this quarter, back out trading gains for the immediate quarter that went by or a similar period last year, operating profit was up 35%. So the underlying momentum is quite strong, and we believe that should continue. The one area that we saw an impact which was certainly on account of trading gains being way lower than in either the sequentially previous quarter or the same time last year. But that's well documented. I'm not stressing more on that. We had identified a pool of education loan accounts in Kerala which had got some dispensation. Even last quarter we had signaled that they were under stress, and the regular sort of state government had probably signaled that they would give some kind of relief to these customers. That had not yet come through. The deadline is 31st January, but we took the entire hit in Q3. So to that extent, the slippages were inflated by 71 crores, which is largely the education loan impact. Retail without education loan has shown marked improvement at about 79 crores versus 100 plus in the previous quarter. So on balance, we think the underlying franchise performance is strengthening. Our RM model is working. The strategy of branch-led distribution heavy is beginning to gain ground. Distribution and digital are working quite well together. There is momentum. The interest income, like I pointed out, is an all-time high. We had exceptionally good recovery and upgrade this quarter, which did help the overall managing the provisioning and the financial impact of higher slippages that were on account of this education loans that I pointed out. So our credit costs were 59 basis points this quarter compared to 71 the previous quarter. So on balance, the quarter turns out, barring the impact of trading gains, very much on track, and we believe this momentum will continue as we go into FY19. But importantly, we have the milestones to cross in March. Many of them are sort of self-imposed, both in balance sheet targets and momentum targets that we have set for ourselves. But the team is confident that those are very much within our reach to deliver. The only thing that we are guarded and watching out for is the migration of the accounts that had either been restructured or sold to ARCs, because sale to ARCs, the effect is the same, because if there's a degradation on their performance, the provisioning is the same as what it would have been if it's on our books. So resolution is the important part. Recognition of NPAs have all fully happened. So we think the resolution will happen between Q4 of this quarter and next year first quarter. So those are headline points. We can open it up for questions and answers. Like Raj mentioned, the entire senior team is there, but I'll try and watch most of it and ask our senior team to step in as and when it's required. So go ahead, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Nagaraj Chandrasekhar from Laburnum Capital. Please go ahead.
Yes, thank you. 2 questions. First, could you give us a little bit more color on exactly what went wrong with the education accounts? What was the call we took in hindsight? What were the factors we didn't anticipate that caused these loans to slip, and how does that, does that in any way change the way we're looking at this category of loans or, overall retail credit policy? And the second is corporate slippages were also a bit higher than last quarter. So, to the extent that you could give us some color on what's driving those this quarter, whether it's just fairly granular slippages or whether there's anything particularly lumpy in that would be very helpful.
Sure. Let me take the corporate one first. The 98 crores is literally 3 accounts of between 30 and 35 crores each. So there's really no lumpy account or anything that's of any worry for us on that count. And that may continue into the quarters ahead. There will always be 1 or 2 accounts, 30, 40 crores. So we have factored for that between 50 and 70 crores. This quarter it was 3, but I'm not, one of them is recoverable, but yes, that's in fact one of them will, there's a great chance it will come back between today and tomorrow, but as of recognition date, they have not served their dues.
So you mentioned last quarter was slightly abnormally low, and next several quarters we should assume somewhere in the 50-100 range.
In corporate or mid-market, it's never really, so there is no trend line to say it will be this, but if you take a 8-quarter period, we've been seeing roughly between 50 and 70 crores in corporate. I'm talking about 8-quarter averaged. So you could argue that, the next 2-3 quarters, this may be the kind of run rate. On education loans, the breakup, let me just give you the education loan backup. If you've seen, that's why in our deck also we put the 5 quarters education loan. Traditionally has been 7, 8, 10 crores, and some quarters even lower at 2, 3 crores. And that's the normal run rate. In the beginning of July of 17, the state government came out with some kind of concession, so to say, which encouraged even bona fide people who were serving their dues to look for some subsidy. And therefore everybody is now tempted to go out and see if they can get the state government subsidy, and therefore they have stopped. Even the guys who are paying are not paying. So our overall education loan book is roughly about 300 crores, and most of it is in Kerala. We have not grown that book for a long time, except where it's a mandatory growth. So this 70 crores is some kind of a reflection of that kind of behavior, influenced by some kind of event that the state government encouraged. We had seen this problem coming for 2 quarters. Last quarter we made a provision for it. That's why you didn't see a large provision impact of that in this quarter. So we upfronted it in this quarter because we said we don't want to drag this alongside. For example, Q4 this will come down to a single digit number.
Thank you.
Just to complete the question, you had said, does it have any retail credit policy? We see each of our retail products differently. The policy and the underwriting standards and the underwriting mechanism varies. It's sort of fit for purpose. Education loan, wherever it's below 4 lakhs and it's mandatory, this is a challenge.
And then dates got extended from 31st October to 31st
January.
31st December 1st and from 31st December
January.
to 31st January. Had it been only up to 31st December, there would have been more resolutions. Now that's further extended by 1 month.
Yeah, please. Next question.
Sure. We take the next question from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So just again on this corporate slippages of 98 crores, would it be, what is the status of this RBI risk-based supervision for our bank, sir?
The supervision is over, but the report has not come out. We don't see anything dramatically altering the picture. The slippage run rates will be similar what you saw this quarter.
Sure. And there was no this non-fund based to fund based devolvement in this quarter, of these 3 corporate accounts?
No.
And secondly, sir, in terms of provisioning, can you give the breakup for loan loss provisioning and investment depreciation for this quarter? And how are we placed on the AFS portfolio?
Sure. The loan loss provisioning for the quarter is 120 crores. The investment provisions is about 11 crores. Including SR, 19 crores. 19 crores. Treasury related 11 crores. Investment provisions, SR provisions 8 crores. Total 19 crores.
Sure. And sir, do we have some sort of, okay, so...
Please go ahead.
Yeah. So, second, this thing on gold loan, sir. Is it still the environment is still not conducive for banks in general to grow that book, or how do you see that book?
Yeah, we are growing gold loan, but most of it is agri gold loan. The retail gold loan growth has improved, but certainly nowhere near where we would like it to be. We are not against it, but the opportunity to grow gold loan, not only for us, for most banks, seems to be fairly modest.
Sure, sir. That's very helpful. Thank you so much.
Thank you. We take the next question from the line of Hamsini Karthik from Smart Investors. Please go ahead.
Sir, hi, sir. Just a couple of doubts. One, I'd like to understand what is your exposure to the second account mentioned for resolution under the NCLT.
Excuse me, this is the operator.
Your line is trailing off, please.
So I just want to understand your exposure to the second list of accounts referred for resolution under NCLT, and also want to understand the trajectory of SME loans, because we see that on the increasing mode over the last couple of quarters. So,
our SME growth is very much a sort of part of the strategy of the bank. In fact, that is our strongest area of the bank. When I say SME, I mean small, medium, and micro and middle market. So while we report SME as anything above 5 crores to 25 crores, where you're seeing a growth of 20%, our large part of our corporate is also in the mid market, which is in the 35-40. So that's the primary focus of the bank, and that's growing quite well. And we will continue.
On the NPA side of SME loans, sir?
You would have noticed our NPAs have been traditionally around 100 to 120 crores on a growing denominator, and that is how it will be. And our SME book is a largely secured book. In fact, when I mentioned strong recovery upgrade this quarter, a lot of the recoveries have come from past period slippages on SME because they are well secured. Okay. Then the other question you had asked us about the second list of the NCLT, there are only 2 accounts. There are only 2 accounts and they are well provided for.
Well provided, I would assume above 50%.
60%. 60%.
Above the regulatory threshold.
Okay. And if you could quantify the exposure?
55 crores.
55 crores. Okay, sir. And just one last point. I also noticed that the CASA ratio has slightly moderated compared to the demon levels. Any direction you would want to give us on that?
Sequentially,
current trend more sustainable, and the demon levels may not really happen again.
the demon period, like many other banks, we saw a lift up, and that's moderated. And you see sequentially Q1, Q2, Q3, every quarter it's improving. It's at 33% this quarter. We are certainly working to build it up to 35. But I want to qualify, which I said in the last quarter call also. All our CASA is at the card rate of 3.5% for savings. There are institutions which bid much higher to grow CASA at 6%, which is like term. We haven't done that. All our savings, that's why our blended cost of deposits is trending down at 574, and that will continue. So I would look at the CASA not in standalone. I'd look at CASA retail granularity of the portfolio. You would have noticed 92% of Federal Bank's deposit is retail, and combine that with the overall blended cost of deposits. As long as I get CASA at or around below that, it will be 5.73 is our total cost of deposits, and that's been coming down. And therefore, we think we are endeavoring to grow CASA very strongly. But to get back to 35%, which is the demand number, is our number one milestone.
All right, sir. Thank you very much.
Thank you. We take the next question from the line of Arihant Bardia from Catalyst Global Equity. Please go ahead.
Congratulations, Shyam, for touching 1 lakh crore in deposits.
Thank you.
My question with CASA you just answered. I want to understand the cost income trajectory as well for the next 3 years.
Yeah, we've guided in the beginning of this year and last year also between 50 and 51%, and exit rate of about 50% for FY18, which we think we will hit. This quarter was slightly exaggerated because of two things. One is the denominator effect, the trading gains falling off by almost 65 crores combined to the previous period. Even half of it is there, the ratio would have been much different, because the incremental cost increase is roughly about 20 crores for this quarter sequentially. Because I had said there are 3 areas we're investing into. One is the marketing and the brand, second is IT, and the third is in terms of the people related. There's a fourth that has arrived on the picture, which is the impact of GST versus the service tax era. The GST era will add up about roughly 1.5 to 2% increase in cost. It's not unique to Federal. It's going to be a feature that is there. But that said, we're still guiding for a 50% exit rate. If not Q4 FY18, it will be Q1 FY19.
Okay. And with respect to your strategy with respect to the relationship managers, are they a purely new workforce or a shuffling of the existing workforce into newer roles?
A large part of them are new recruits. There are some existing people who have been reallocated based on performance, particularly on the retail side. On the corporate and SME, most of them are recruited and growing in the system.
Okay. That's it from my side. Thank you.
Thank you. We take the next question from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Just a couple of data keeping question. What is the upgrade and recoveries during the quarter and write-offs? And second is what percent of the book is now on MCLR?
Recovery and upgrade this quarter is 220 crores. Last quarter was 135. The previous year, same quarter was 110. So recovery and upgrade, as I mentioned, has been very strong. The second part of the question was
Almost 50% is MCLR.
no. You had another text to the recovery upgrade. Sorry, Dhaval.
Write-offs. The write-offs during the quarter.
Nothing. Nil. 1 crore. 1 crore. Nothing at all. And MCLR of the book is about 75% of the, roughly 80% of the book is on MCLR.
Okay. And any update on FedFina, and IDBI Federal?
FedFina is in very advanced stages. We are working through the term sheet and the reference documents. With appropriate approval, we can announce it in the course of the next 2 months or earlier. IDBI Federal, there's an entirely sort of detailed process underway and value discovery is going on. Our position on that will be informed by what we see as ultimate value that we will get. we are not biased to either sell or exit or upgrade. We are open for all options. But there is inherently very strong value which is getting discovered.
Sure, sir. And just lastly, what would be the differential in the incremental yield and back book yield on the corporate book?
Again, it's very linked to the profile of the customer and the by segment. But roughly,
on a weighted average,
The wholesale bank yield will be about 9.5% presently on flow. Wholesale bank.
this is back book, right? The overall current weighted average, right?
Of the current flow is at 9.5.
Okay, fine. Thanks, sir.
Thank you. Next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
The wage revision which will
Excuse me, this is the operator. Mr. Shah, may we request you to use the handset, please?
Yeah,
Not
sorry, with respect, yeah, now is it audible?
Yes, it is. Thank you.
Yeah. So with respect to the wage revision, which got effect from say November 2017, so do we see that impacting the overall salary base for us, and have you started providing for it?
Yes, we have. We have started providing 2 months of this quarter. We provided, I think, to 11 to 12 crores this quarter.
Okay, and despite that, the overall employee cost is slightly on a lower side.
The slightly lower side because we were benefited by yield. The only upside when yields go up is some impact benefit comes on the pension costs.
Okay. And overall, in terms of other OPEX, so whatever is the sequential growth which is coming in, that you highlighted would be also on account of GST.
No, I didn't say the entire thing. I said there are elements of that which is marketing, which is technology, which is this time there was a one-off cost of about 5 crores for recarding for EMV, which is a mandatory spend that we had to do, and the other is the GST. GST impact, I said roughly about 2% increase versus a service tax era.
Okay. And what is any movement on the restructured asset side?
This quarter, 2 of the accounts, in addition to the existing standard restructure, has become restructured, for about 70-80 crores.
No, but overall, if that number is actually coming off,
that is because some of the bonds have come down.
Okay. Okay. So largely it's on account of bonds.
Yes.
Okay. And just one last question in terms of the overall AFS book and the duration out there.
Usually duration we don't share, but
It's between 2 and 2 and 3. 2.5.
Between 2 and 2.5.
And proportion of AFS?
We are quite close to the mandatory requirement of 9.5. We don't carry 6-7% surplus SLR. That's why we are saved.
Okay. Okay, cool. Yeah. Thank you.
Thank you. We take the follow-up from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Yes, just follow up on the question on CASA. So you said you were making progress towards 35%, which is a great idea. Any rough time horizon for this goal? Is this a 1 to 2 year goal, a 2 to 3 year goal, a 3 to 5 year goal? Can you give us some indication of that?
FY19.
Okay, all right. Thank you.
And here I want to point out is that as close to the card rate as possible.
Understood. Thank you.
Thank you. Next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Couple of questions actually. To begin with, how do you measure the performance of the RMs, or rather, for all of us sitting outside the bank, how should we look at that? Is there a way to figure this?
At a very sort of aggregate level, you would look at the metrics that we are delivering in terms of growth and our overall performance and the relatively lower slippages and the credit quality. The RMs, like I mentioned, are spread across a range of businesses, and therefore each of them carry KPIs which are very different from one and the other, and their rewards are heavily tagged to their volume growth and the flow through of the credit quality that they bring in. And if it's a liability and a wealth management RM, they have different KPIs. So it's sharply targeted at each business vertical and the priorities of that vertical. The aggregate measure from an outside point of view would be the one that we often discuss in terms of growth and the relatively high standard of the book quality.
Right. Just a point that because you mentioned, you also assess the credit quality. I'm sure that is, that quality is assessed with a lag, right? Because loans typically won't default immediately.
Yes, you're right. And their rewards are also linked to that.
Right. Okay. Second is, could you touch upon the NRI deposit flow? How is that working? And while talking about it, could you split the, out of your current account, savings account, and term deposit, the percentage of NR deposits?
Saving 11%.
Our total NR deposits of our entire franchise is close to 40%. Our NR deposits have grown very robustly and continue to grow. We are quite delighted in any market condition. We seem to be the port of first call. We are seeing that momentum continue. There are a lot of news reports on the overall NR volumes dipping in the country, but as you have noticed, our share of growth is only increasing further. So NR as a business, we are seeing strong growth, and even through periods when there is reportedly job losses in the Middle East or slowdown, we have seen sharp growth because we are getting a larger share of the flow. Curiously, or maybe more intuitively, whenever there is any sort of disruption or some kind of concern in the Middle East and those parts of the world, there is movement of money back into India, and whenever there is movement of money back into India, we are the beneficiary. Also, the largest part of the segment of the market that we focus on is more the must send money to India category, and therefore when they must send, we are the preferred conduit for money to come in. So we remain confident that the NR growth will continue. The same cannot be said on the other side of the NR in terms of the credit performance, which is where we have started being very careful on how we underwrite home loans and SME loans per linked to the NR, and we have consciously slowed down some part of the business for almost a year.
Right. But isn't it the case that, at least on the NR liability piece, people who might be losing their jobs will obviously transfer the money back? Isn't that why the volumes would be higher? And therefore, that need not be a proper metric of,
You could say that if it is a one-time and a one-off, but if you take across 8, 10, 12, 14, 16 quarters, you would see a pattern. We haven't seen any of that nature.
Right.
A large proportion of the people on the ground are support system. Even during wars and all that, post-war robust growth.
Also, I think the other important part which we often stress is that as we sort of get our non-Kerala franchise growing quite well, we are seeing the NR in that part is now beginning to be a meaningful part. In the past, it was 2-3% of that. Now it's 10% of that volume. So there is momentum there too.
Right. Okay. And can I have a couple of data points? You used to give out the current account split between Kerala and outside Kerala. Could we have that as well as for the comparable quarter last year and the total employee count?
Total employee count is now 11,950 or thereabouts. The current account mix, you wanted to know the split, is it?
Yes.
46% is network 1, 54% is network 2.
Right, okay. Sorry, and the final question. When you talked about the life insurance venture, what are the conditions under which you will sell versus retain the business?
Maybe premature for me to answer because there's a process running, and the good news is the process is bringing up even the first level of bidders have expressed good interest and value. So let that sort of mature, which is about 30 days away. And since it's 3 different partners and each one has a different priority, we have to be very sure that if one is exiting, then the franchise value continues. So we want to be sure that if we are wanting to get the best value out of that, we want to remain invested till the right time comes. So I am not in a position to comment which way, where, but debates are underway. We think in about 60 days, by end of March, we'll have greater clarity. Mid-March, we should have greater clarity on way forward. The good news is it's a substantial value which is emerging through the franchise.
And correct me if I'm wrong, the partners will have the first right of refusal, right?
No, the original shareholder agreement visualizes that the two Indian partners, if they want to dilute, can offer it to the international partner, who can go up to the mandated limit of 49%.
Not between the partners, Indian partners.
No, unlikely that may happen.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. We take the next question from the line of Darpin Shah from HDFC Securities. Please go ahead.
Darpin, little louder, please.
Yeah. Can you hear me now?
Excuse me, this is the operator. Mr. Shah, there's a lot of static noise coming from your line. Can you use the handset, please?
Hello?
Yeah, we can hear you loud.
Yeah. So can you provide sector-wise breakup of the restructured book, and what proportion of these exposures will be coming out of moratorium in next 1 to 2 quarters?
Okay. Restructured book sector-wise. The biggest is infra, which is power, road, aviation, and
so if you can provide the absolute or ballpark numbers for this exposures.
Okay. Infra is about 800 crores.
Okay.
Aviation is about 250 crores.
Okay.
And the balance is about 250 crores. Iron and steel, textiles.
And how much of this will be coming out of moratorium in next, say, 1 to 2 quarters?
2 accounts in this quarter.
Quantum?
500 crores.
And this will be from infra only largely.
Sorry, pardon me?
So this will be largely from infra only.
Sorry, I have to correct myself. This quarter, 300 crores. Sorry, apologies. 300 crores. It's largely the aviation.
Okay, fair enough. So how is the SMA2 trending us, and if you can just give some ballpark number on that?
It is at all-time best.
Any ballpark number for it, sir?
33% reduction over the last 12 months.
Okay, fair enough. And one last thing is, sir, if you can provide absolute number of Ka and Sa.
Absolute number of Ka and Sa.
4,800 is Ka. And 28,000 approximately.
Yes, 4,800 and 28,000.
28,000.
Okay, great. Thank you, sir. All the best.
Thank you.
Thank you. Next question is from the line of Sri Shankar from Prabhudas Lilladher. Please go ahead.
Hi. First of all, congratulations on crossing 100,000 crores on deposits.
Thank you.
A quick question on a couple of factors. The growth that we have seen, is there any specific region has seen an increased growth, or is it uniform to most of the regions that we operate in?
If you back out the corporate, which certainly has a bias to Western India, but everything else is equally paced between all our zones in the country. And we continue to dominate our share of flow in Kerala, though we have slowed down on the SME side by choice. And across Mumbai, Chennai, Bangalore, and North, we're seeing fairly equally distributed growth. Actually, East is also doing well.
Okay. When you say that you have slowed down on MSME, etc., SME, are we seeing some kind of headwinds, or are you anticipating some headwinds out there?
No, I think the data points point to certain signs. No, I think it was an earlier conversation on the credit side, NR side, and I said deposits are continuing to be robust. Credit, we are being watchful.
Okay.
Network 1.
Yeah, I'm talking about Network 1.
Yeah.
No, he's asking Network 1. Yeah. He's from this part of the country.
On the other side, in educational loans, where are we seeing these slippages? It is in nursing, or is it in engineering, or the high-ticket loans, or on the lower quality, I shouldn't be saying lower quality, but nursing, etc.? Where are we seeing this stress maximum?
As you know, Sri, the large part of the education loans below 4 lakhs in the state of Kerala has largely been for engineering and nursing.
Yeah.
And therefore, that pool of customers, when they are encouraged to wait for some dispensation, are now tempted to not pay. Here I want to point out, in their minds they have not defaulted because January 31 is the date when the government will take the decision on them.
That date should be standard.
They should be standard on that date.
Yeah.
We, because it has crossed the 90-day mandatory, we have taken the hit.
Okay.
There we are, every effort is by 31st January. If they want the dispensation, they may upgrade also. But that's for them to decide.
Okay.
Because to get the benefit of the state government, they have to be standard on the date of benefit.
Okay. And here you mentioned in the presentation that your salary accounts have seen a 57% increase?
Yes, it is.
Where are we able to get these incremental salary accounts in the sector?
The 336 RMs that we talked of, in fact, this quarter we did 125,000 payroll accounts.
Okay.
And a large part of it is coming through either digital or what we call the instant account opening using tab banking.
Okay.
So we are seeing and our digital capabilities are quite robust. We are seeing sharp growth. The RM model, which often has been the question in terms of what is it doing for us other than getting credit, is to also open doors in good corporates and mid-market where we can go and do the entire client, and that's beginning to give us a rich outcome. So the cross-sell focus is bearing fruit. And the RMs are heavily linked, as in we have a corporate RM, we have a mid-market RM, retail RM, and a customer service relationship manager. The combination works. That's for the personal loans.
Okay. And this, you have been able to get this incremental 125,000 at the cost of PSBs or other private sector banks?
Would be a mix, I would think, because the good corporates whom we are banking largely from the corporate side some part are multiple banks, but we are seeing the sluggishness on some of the larger PSBs or willingness to take exposure is helping the corporate to have a fresh look at banks like us.
The new recruits.
And we are getting the incremental flow of recruitments they are doing or the replacement hiring that they are doing.
Okay. Thanks. I'll come back later in the queue. Thank you.
Thanks.
Thank you. Next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hi, good afternoon. Just a few questions. One, of late you started to increase your share of borrowings in your balance sheet. If you could just kind of broadly highlight what's the differential that you're seeing on cost or what benefits are you getting here? Second, on the educational loan, just a clarification, how much are you expecting in terms of repayment of the 70 crores of default? Third, if you could give us a breakup of your provisions. And fourth, GST momentum you have seen out there. Are you actually seeing some amount of actual increase in revenues across all your clients that they've started reporting? Or is this growth just a market share growth out there? Thanks.
So Mahesh, first one is on the borrowing side. You would have noticed that our CD ratio has, drastically improved. It's about 900 basis points YOY from about 76% to 85% now. And as a result of that, we have taken some refinance from one of those institutions like NABARD, Citi and all, which is CRR, SLR exempt. So that is coming on the borrowing side. It's not the, call or, the routine borrowing. It's a long term at a very competitive price. And that was taken in September. So I think because we have the earlier refinances also getting matured. So it's partly the replacement of the existing borrowing and additionally something. So that's the component.
You had four questions. One was on borrowing. Second, I think, was your our expectation on what is the education loan recoveries that we expect this quarter. Was that the question?
Yeah. Yes.
Early to tell because every month the date gets reset by one.
Three times it does.
What was 31st October became December 31. December 31 became January 31. So if the January 31 deadline is a hard stop and there is no change, we would think at least 30% of them should be looking to become standard to benefit from the dispensation or the benefits, the subsidy they are getting. But we will wait for that to mature and we will see how that plays out. What is the third question? Sorry, since you short off me.
Just short. It was the breakup of your provisions for this quarter.
I think we mentioned 120 odd crores is credit provision, 20 odd crores is standard asset provision, and the overall treasury.
20 is investment. 19 is investment.
19 is in investment provisions.
Okay. The last question was on the GST side.
SR.
Yeah, sorry, go ahead. Last question is on GST.
On the GST side, just trying to understand, have you started seeing some momentum in terms of credit demand on GST, or is it simply market share gains that you're seeing out there?
Credit-related question.
We are seeing market share gains very evidently across. Sorry, go ahead.
No, the question is in reverse. We can see the market share gains. We're just trying to understand, on the ground, have you started seeing people asking for increased credit for increased sales?
It's nothing very pronounced. I would not say that there's any sharp change on that count.
Okay, sure. Thanks.
Exporters had definitely looked at some additional, finance because they were not getting the
GST
credit back. So that was there. From exporters, there was certainly some demand. But that has also been, I think, taken care of now.
After November.
Yeah, now after receded, that demand is receded.
Okay, sure. Thanks a lot.
Thank you. We take the next question from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Hello.
Yeah, go ahead, please.
Hi, this is Sumit here. So, first question is on loan yields. So, what percentage of the book is base rate linked, and is it true that the bank hasn't reduced base rate since December 2015?
We haven't changed base rate. Yes, you're right, for the last 2 years. Our loan book, like I mentioned, roughly 80% is on MCLR.
Okay. And why would that be? If I think about the base rate formula, deposit costs would have come down, I presume. So, how is it that the bank hasn't cut base rate?
Base rate is not mandatory change. MCLR mandatory changes. And it's a competitive stance. So, wherever possible, we are trying to. Anyway, the spread above base rate is what customer is bothered. Base rate is not. So, wherever there's an opportunity to give the customer the concession, we are working on it. And it's heavily performance linked and credit quality linked.
Okay. Second thing was on SME loans. The SME loans outside Kerala is doing quite well. Wanted to check if there's a difference with respect to collateral levels or LTV levels in the SME business.
Non-Kerala, the collateral is relatively lower. Kerala certainly is much higher.
And what would be the gap like?
There's no gap. It's case to case.
I would not be able to.
We are not running a program on SME. We are doing individual bespoke credit underwriting.
Got it. And last question is basically, is it possible to get indicative segment-wise ROE that Federal Bank would be making in corporate, retail, and SME?
We will, to be honest, we want to be a little mindful that from April 18, we will give a better look on that because this has some moving parts. We are trying to get the best estimates of that. So I would buy time till at least end of financial year for us to make a better pitch on that.
Okay. And if I can squeeze in a last one, over the last 1.5 years, the corporate banking has done very well in terms of loan mix and share of high quality loans continues to rise. And to an extent, the pressure on loan yields would have been offset by improving loan to deposit ratio, etc. How do you think about this incrementally? Because high yielding corporate loans continue to rise. Even in retail, you are seeing an increase in share of mortgages, and gold loan is not that picking up that well. So from a margin perspective, if we continue to grow corporate and mortgage at a faster pace, does that mean margins could come under some bit of pressure?
Our business mix, if you take the last 3 quarters, sequentially each of our businesses is growing between 5 and 6%. And that will continue. And we have carved out between corporate, mid-market or the SME business of the commercial banking, and then micro, and that comes under business banking. Each of them have mandates, each of them are having a different yield mix. So the business banking comes at roughly 11%, the corporate comes maybe at 9, 9.5, like Ganesh pointed out, and the mid-market around 10, 10.5. So each of them have a different business mix and a business profile.
Product mix and business.
And I think the margins, like I've always mentioned, as a function of many things, not just credit growth or the mix of the credit book is one. Second is the regular utilization of credit as opposed to period end, higher CD ratio. And more in this quarter, it was also influenced by sharp recovery and upgrades. So we think the blend of all this should keep us in the 325, 330 space.
Okay, got it. Thank you.
Thank you. Next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Go ahead.
Yeah. So I just wanted to understand, like, what would be the difference in the incremental spreads on SME book within and outside Kerala?
No, the question didn't come through clearly, Rohan.
Hello.
What will be
What is the incremental yields in SME within and outside Kerala, sir?
No, I don't think there's any geographical difference of any nature. And
Yield is based on rating of the customer and the profile of the customer, and less to do with geography of the customer.
Okay, but sir, what will be the average yield in SME and retail right now? Incremental?
SME is between
10.5 for SME.
Between 10.5 and 11.
10.5 and 11. Okay, because sir, one of the customers who is based out of Kerala, so the competitors based out of Kerala, they are indicating much lower yields on the SME space. So just wanted to understand, like, what is driving the difference in terms of we being able to charge much higher yields in SME?
No, I think
So what would be
name, I don't know which bank you're referring to, but they are indeed going into the market at much lower pricing. I do wish they didn't. But that apart, it is, there is no one answer. It is just the ability to have a better engagement with client, full relationship, and importantly, we are able to offer much more than just credit.
Okay. And so, like, what will be the outstanding SDR S4A 525 at the end of the quarter?
Exposure to?
SDR S4A 525 outstanding at the end of the quarter?
That has not much of a relevance, but what is our current SDR? I think not a significant sum, but anyway, since you've asked the question.
2-3 quarters, we won't added anything on that count, so probably become a little...
He wants an outstanding.
Historical stock. Here.
Less than 3. SDR is less than 94 crores.
94 crores.
Yeah.
Okay. And so, like, I think during this con call, there was mention that we are slowing down in the SME space in Kerala, SME lending in Kerala. So, sir, just want to understand, is there any specific stress that we are seeing there, or just a strategy?
I think when we say slowing down, it doesn't mean we are winding off. It is just that we are being watchful, and given certain sectors of stress, given the impact of possible, the related NR stress and whatever, we are being watchful. And sectors like cashew and certain other engineering colleges, medical colleges, we are being very watchful.
We are doing cherry picking, we are not slowing down.
Okay. And so, like, what will be the retail yields, incremental retail yields overall and the portfolio level?
Retail is about 10.25 and the portfolio is also in the same space, a little higher.
Okay. Thanks a lot, sir.
Thank you.
Okay.
We take the next question from the line of Animesh Shah from L&T Mutual Fund. Please go ahead.
Sir, in the opening comments, you mentioned that key monitorables in the coming quarter will be transition of restructured assets and the ARC receipts. Can you elaborate more on that?
Yes, I can. I think the accounts that have been sold to ARCs, if they are anyway migrating from D1, D2, D3, The provisioning impact is the same as though they were on our book as per new regulations.
Despite having been sold to the ARC.
So that's something that we are watching out for, and we do anticipate some in this quarter.
Okay. And on restructuring, any?
Restructuring, we don't see any significant challenges this quarter.
Okay. Thank you.
Thank you. We take the next question from the line of Rahul Maheshwari from IDBI Asset Management. Please go ahead.
Good evening, team. I have one question that what are your internal benchmark in terms of your branch productivity, and going from last 3 quarters, we are finding the branch has been stayed at 1,252 kind of branches. So can you give more color that what is the profitability or kind of the break even and branch expansion goal which for next 2 years kind of which will be taking place, or you would be betting more on the employees sales force which we added in the current quarter?
Yeah, I think I had said in the last time and this time also, we haven't added actually not for 3 quarters, we have not added for 2.5 years. Our philosophy is branch-light distribution heavy, which means we want to make sure that we are adding more feet on street and distribution power, all forms, digital, human beings, BCs, and powering up our existing network. We may certainly look at certain branches may getting redistributed or relocated and rationalized. That we will do. The metrics for what we consider as a branch profitability, there are I think a range of them, so I can't sort of singly say one. And the traditional model, people used to say X lakhs per branch, all that I think is passé, so I'm not even venturing to give those numbers. But we have a range of parameters, and we look at profitability, loss-making, branches that are below base at any point in time, and all those are being sort of continuously reworked. So effectively, if you see our branch network have grown the business, overall if you're growing 20-odd%, the branches are also bringing in, pulling their weight for different businesses, and they continue to be a large liability and fee generation, which we'll do. So the answer to your question is there are multiple metrics, but we're not looking to add many more branches. We're looking to add many more distribution opportunities.
So how many branches any per annum you would be adding, or the?
We haven't added for 2.5 years, so we may at best add another 50 in the next 18 months. But that's very subjective. We haven't looked at any large number consciously.
And due to this asset-light strategy which you have adopted, branch-light strategy, what kind of by FY20 the cost income we can come, because the more of operating leverage would be coming if you're not adding and.
Yeah, I guided for 50% as the exit rate this year. We may keep around that guidance for 19 and 48 for FY20, 48 to 49.
Okay. And on security receipts, how much provision coverage has been there on your?
No, what is the coverage? Sorry, I didn't get the question.
On security receipts, SR, how much PCR has been provided?
800 to 600.
No, how much is 800 crores is that security receipt right now, right?
About 200 crores would be the.
So
that is in this quarter. Cumulative. 95 crores on 600.
95 crores on 600.
95 crores on 600.
Yeah.
Okay. But because in your presentation, the slide which was there, the face value is 1,090 and book value is 870. So can you just give that, reconcile that? What is 600 crore and what is the 870 crore then?
Sure. Which one? No, this one. This is 873. This one.
But net book value would be maybe is 800.
Which is the NAV.
Can you pardon?
873 is the NAV and 95 crores is the provision.
Okay. Thank you.
Thank you. We take the next question from the line of Anshu, an individual investor. Please go ahead.
Talking of 480 and all that after this.
Yeah. Hello, very good evening. Many congratulations for the great set of numbers that you have reported. My question is related to the housing finance. I'm seeing that a substantial portion of the growth for our bank is coming from housing finance, both on the retail as well as in the corporate side. So can you give a color on how it is really panning out in terms of the geographies, plus in terms of geographies, and more importantly in terms of looking at whether this is affordable housing which is growing, or is it across the segment that the growth is being seen?
It's very widely spread. Affordable housing also has multiple descriptions. Our average ticket size on the housing loan is about 30 to 35 lakhs. So it will be partly in affordable and partly is the regular housing loan. So there is no bias to that. Bulk of our growth is coming in markets like Mumbai and Delhi and Pune, where the average ticket size is higher.
I see. Okay. And the second question that I have with respect to this is that what's the incremental the loan segment which has grown in the last quarter? What's the rate at which you have been lending to these housing finance companies?
Housing, as you know, is very competitive. Whatever is the best banks are offering.
Housing finance.
Housing finance or housing?
It's like any other corporate loan for us.
Yeah, in the corporate segment, yeah.
It's like any other corporate loans. We don't have a specific rate for housing finance company.
Okay, so what would be the rate at which you are lending to them?
As we said, it's closer to 9. Our corporate book flow is at 9.
Okay. Okay. That was from my side. Thank you.
Thank you.
Thank you. We take the next question from the line of Jayant Kharote from JM Financial. Please go ahead.
Sorry,
excuse me, this is the operator. Mr. Kharote, may we request you to use the handset, please?
Hello?
Yes, it is audible. Thank you.
Yeah. Hello, sir. Congratulations for the great set of numbers. I just wanted to know the number for our portfolio buyout this quarter.
Nothing. Zero.
Okay.
We haven't done any portfolio buyout for almost a year now.
Okay, sir. Okay. Thank you, sir.
Thank you. We take the next question from the line of Pritesh Bum from Prabhudas Lilladher. Please go ahead.
Hi. So your tier 1 quarter hasn't changed. Anything to read on that?
The credit risk book has improved, so there's no major change in Q1, Q2 to Q3, right? The risk weight has not changed. So tier 1 has not changed much, right? So yeah, so there's not much risk weight change. In fact, the portfolio has improved in quality, so the risk weight has improved.
So the absolute number also will get impacted from that, is it?
I would think so, yes.
Because it was...
Credit risk weighted, how much is that?
1,000. Wilson has just sent out an MI.
Hello?
Yeah, 1 second. Yeah. So your question, please. Repeat the question.
So what I was asking is the tier 1 absolute quarter hasn't
Yes.
changed.
Yes. It has moved from 14.63 to 14.41. Okay. The CRAR, and almost all of it is tier 1.
Other than...
So second question is on the fee income side. So we've seen good growth in the advances book, but the core fee income has not moved much quarter basis.
No, I think the fee income ex trading gains is tracking credit growth. Yes. And we are keen to push that up further, which we are working on. If you take Y on Y, sequentially the number is a little jinxed because of some of the one-offs, which is a reversal. But the credit growth and the fee income is tracking. In fact, processing fees and FX have grown more than 20%, each of them. The only thing on the other income, which is trending below, largely driven by where yields are. This quarter we saw a sharp fall. But other income, we're not saying at the top notch, we are growing 20%.
So the core fee income should continue to grow at a good pace, is it?
Yeah, we are keen to do it at least 200 basis points higher than credit growth, but that's still work to do. In fact, we have internally said, and from next year we will look at fee as a market. I mean, our share of fee. Of course, there's not substantive market information, but we'll try and capture that so to see, like we're growing our credit growth, what is our fee market share growth also.
Okay, thank you so much.
Thank you. We take the next question from the line of Sanket Chheda from IDFC Securities. Please go ahead.
Hello.
Yes, go ahead.
Yes, sir. You said that slippages will be similar next quarter as for a couple of quarters. So it would be around 400 crores is what you said, or it's barring that education loan?
If you add the impact of any potential slippages on account of the RBS that has come through, we think roughly between 350 to 400 crores it should be.
Okay.
So whatever education loan will get replaced by any other bulk that we'll see.
Okay. Sure, sir. That was the only question.
Thank you. We take the next question from the line of Gaurav Gyani from Centrum Broking. Please go ahead.
Yeah, thank you for taking my question and congratulations on a great set of numbers. Just some clarity on this education when I probably joined the call a bit late. Can we see such more instances in other states also? And if I could have the quantum of exposure towards the education loan segment and the Kerala part. Thanks.
Largely our education loan book is in Kerala. I think roughly about 500 odd crores is in Kerala. This is hopefully a one-time event in one geography. If it spreads, it could. But our book ex Kerala is very small. And in Kerala, for the last 6 months, they have been deferring the date for keeping the account standard and the promise of some kind of discount of, I think, 60% waiver 40% waiver has been offered by the state government. But that date keeps shifting. So it was October 31, then became December 31, then it has become January 31. And because by the time the account had slipped, because even bona fide customers who are paying are now looking forward to this benefit, and therefore we have taken the hit. Do we anticipate this in across other states? Not quite. And if it does, it doesn't affect Federal Bank.
Sure. Just one more thing, sir. So when the government says that the 40% will be waived, which means they would probably make good the 40%.
Yes. That's the stated position. That's right. For which the government insists that the client should be standard to avail of the benefit.
As on the cut-off date.
Sure. Got that. Sir, just one last question from my side. So, congratulations that this quarter we haven't had any write-offs. So, is it a good assumption that this is entirely from, so the new book has actually come in our advances? Is it a correct, fair assumption?
Yeah, but the write-offs that we ever did were all 100% provided. Vintage of the account depended on, sort of the different vintages. But that there was no write-off this quarter is certainly right.
Yeah. So can this be a trend going forward? Was my question.
In case the migration happens from D2 to D3, and then the provision requirement is 100%, there is no advantage in keeping it as 100%, because that simply inflates the balance sheet. You have the 100% provision on liability side, and you have the asset on the other side, which according to RBI's requirements, directives, needs to be provided fully. So in that case, write-off is the better option.
Sure. So do we assume, can you expect some movement from D2 to D3 going forward?
That is a normal run, and I mentioned in particular some of the SR accounts we do anticipate this quarter.
Sure. Got it. Thank you.
Thank you. We take the next question from the line of Sri Shankar R from Prabhudas Lilladher. Please go ahead.
Yeah, thanks. Last quarter we had 1343 crores of standard restructured, and this quarter is 1425. Where have you seen the incremental restructuring?
We mentioned 2 accounts have moved.
2 accounts. And that NPF at 186, the other remaining 220 crores is the provisioning, right? Non-loss provisions?
Sorry, repeat the question, Chief.
In slide 7, out of the total restructured, NPA is totally 1611 versus 1746.
Correct.
NPA is 186 versus 403 last quarter.
Correct.
So the difference of an NPA is the 220 crores loan loss provisions that you provided, right?
No, no, no. No, this is a sale of bonds also. We've had bonds which we have sold.
Oh, you sold. Okay. Okay. Thank you.
Thank you. We take the next question from the line of Sneha Ganatra from Shubhkam Ventures. Please go ahead.
What is the exposure in NCLT and how much provision we are holding?
I think we mentioned, maybe you came in late. I think the two accounts are well provided. We have over more than 60% provision.
Okay. And considering the Ind AS and the other provision, what would be your credit cost guidance for next year?
We don't know when Ind AS is going live, but the credit card guidance, if you take, we've had some volatility over the last 3 to 4 quarters. This quarter was very good at 59, the previous quarter was 71, and there was another quarter at around 75. We think between 60 and 65 basis points next year, all things being the same.
Okay, good. All the best.
Thank you. I think, operator, we should bring it to a close if there are no many other. How many are there in the line?
So we still have 3 participants in the queue.
Okay. Okay, fine.
We take the next question from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hello. Sir, this is basically regarding your yields on advances. So in the presentation, the yields on advances is mentioned at 9.54%. But in the earlier conversation, you have mentioned that for the corporate it was around 9 and for retail 10.2 and for SME 10.5. So basically not able to understand the max over here.
No, there are 2 parts to the question. One is when we say that's a blended, right? There are some tickets may be, you're asking for what is the average run rate on the new. That's the number we gave. But the blend of the portfolio could have, somebody would have been lent at MCLR, a large business. So it's a mix, and therefore the 9.54 is the blended yield on the total asset book.
After credit cost also. And after credit cost. No.
Yeah?
Okay.
Thank you. Thank you. We take the next question from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir. Just a follow-up from the previous question. So could you just give the blended yield for retail, corporate, SME and agri again, just so that we can reconcile the 9.54? Thanks.
Agri is around 10, retail is about 10.4, business banking is about 11.4, commercial banking is about 10.2, corporate is between almost 9.
Okay, thanks.
Thank you. Next question is from the line of Sanket Chheda from IDFC Securities. Please go ahead.
Hello.
Yeah, go ahead, please.
Yes, sir. In this quarter, there was a sharp jump in investments, so quarter on quarter 13%. So what could have led to this sharp jump?
What's that? Quarter on quarter? Increase in investments. No, sorry, which slide are you referring to? I'm sure you're looking at our investor deck. Sanket?
Yeah, investments.
No, which part of have you looked at our investor deck or where did you pick that up from?
Investor deck only. So this quarter, quarter ending investments are 29,775, right?
YOY has increased 13%, not QOQ. Is it QOQ?
No.
It's YOY.
YOY is 5.03%. YOY also. Yes.
No, sir, it's QOQ. If you see in Q2, the investments were 26,000 crores, 317, and in this quarter, there are 29,775.
Yeah. 29,775.
So there is a sequential jump of 13%.
That was a big buying of as the deposit has grown, possibly some SLR purchase has been made. And SLR purchase has been made in HTM book because the deposits have gone up. There is no other increase.
Sorry, sir, what was that?
Actually, from 31st December, if you see, 31st December last year, same time, the investments had actually fallen by 1,500 crores.
Okay.
So that, because you have to replenish plan for your deposit growth, and accordingly the statutory SLR requirement is there in anticipation of deposit growth as well as the actual deposit growth that has happened. So its increases is only in SLR segment, and that too for HTM category.
Okay, sir.
If YOY growth, if you see, YOY growth, it is 5% only. Investment,
Yeah, YOY is not.
YOY, December over December is 5%.
Yeah.
From 28,500 crores to 29,000 odd.
Yes, sir. And sir, would you provide any light on the off-balance sheet products? Is there any increase, or how you want to picturize that going forward? For there is PML also attached to it. So are you looking to add some products into your off-balance sheet items or fund-based items like bank guarantees and all?
Your question is not coming through. Your question is what? Are we looking to increase?
Hello.
No, your question is not clear.
So your non-fund exposure is very low, I guess. So off-balance sheet items like bank guarantees and letter of credits and all.
I think often we have explained on our call, we don't look at it in that. Ultimately, it's the credit exposure on the client. So whatever gets us the best return we will, and prospectively doing off-balance sheet need not necessarily be a big benefit given the fact that you're going to look at return on risk-weighted assets. So effectively, if it's
because ECL is to be calculated as per IFRS.
So it's not a very in the period when you are trying to show high ROA by keeping some part of the earnings outside the balance sheet, this makes sense. But we are not looking at anything. But short answer is, if it's valuable, we will do it.
Sure, sir. That helps. Thank you so much, sir.
Okay. Anything else? Operator, anybody else?
Yes, sir. We have a few questions lined up.
Can we try and see if there's... Okay, Raj is saying there are 3 more. Okay, fine. Just quickly.
Sure. We take the next question from the line of Arjun Tandon from Matsya Capital. Please go ahead.
Good evening, sir. Thanks for taking my question. Just wanted your comments on the RBI divergence. You mentioned you've not received the report, but they've completed the divergence. But you also said the bulk will be replaced. The educational loan bulk.
Sorry, I didn't say RBI is completed divergence. We are not saying that. We are not saying there's any divergence. We are a bank that last year had almost nothing. So we are certainly in dialogue. We don't anticipate a large number. Whatever it is, it will be accommodated in the numbers I guided for.
Okay. Thank you so much.
Thank you. Next question is from the line of Harish Kapoor from IIFL. Please go ahead.
Hello, sir. Just most of the questions have been answered. Just on the asset quality front, just wanted to get some sense. So you said that next quarter the number on the additions could be around 400 to 450, which is including the RBF recognition. But on the education loan front, I wanted to understand. So you have 300 crore exposure, and the subsidy that the government is giving, is it only on below 4 lakh? And if that is so, then what is the quantum of exposure from 300 crores for that?
The 4 lakh and below is where this education loan waiver is. The large part of the number that I mentioned is in that. But whatever needs to be addressed has been addressed this quarter. So we don't expect that number to change.
So all 300 crores is basically the number you're saying? That is below 4 lakhs?
Yes.
And 70 crores has been provided as additions now. So what is the provision for this specific, bulk assets that has been provided? What is the provision on this that you have?
Normal provision, whatever IRAC norms are.
15%.
But our overall coverage is 70%.
Yeah. Okay. But then this could also kind of increase substantially, right? In Q4.
Means what?
As in, if you could see more higher stress that could come through in Q4.
No, the last date for that is January end, so unlikely that will change. If anything, it should improve.
Okay.
It can improve between today and 31st January.
Fair enough. Okay, sir. Best of luck.
Thank you.
Thank you. Next question is on the line of Roshan Chutki from ICICI Prudential Asset Management. Please go ahead.
So how many of the 30 RMs that we have are assigned to SME business and how many to the corporate business?
55. 60, 55.
60 now.
Sorry, can you please repeat that?
60 for SME and 60 for 55 for corporate.
Okay. And this branch distribution mix between in the rural geographies particularly is pretty low in lower teens.
Our rural plus semi-urban is almost 65% of our network.
So don't you face any regulatory backlash because of this?
No, none at all. We are very much within all our guidelines.
All right. Okay. Thank you so much.
Thank you. I'm told there's one question, so we'll close that out with that. Yeah, please go ahead. Maybe they dropped off.
Sure, sir.
Fine. We don't have to force people to ask questions. If it's over, it's over.
Sure. So just give me 1 second. There's one question in. Just give me a second, sir. So that person has moved out of the queue.
Okay, fine. Let's bring it to a close, Stanford.
Sure. So you can give your closing comments, sir.
Yeah. Thank you all for patiently joining the call. Thank you. This call comes to a close. Thanks.